The forensic accountant recognized the company name on the intake sheet. It belonged to her ex-husband. She walked into her supervisor's office, closed the door, and disclosed the conflict. During their divorce, he told a judge she had no professional skills. She went back to school, passed the CPA exam with a concentration in forensic accounting, and his company had landed right on her desk. She couldn't touch the case, but the single observation she made before walking away would expose 14 ghost employees and $2.7 million in fraud. Let me start from the beginning. When you own 20% of a company, you learn to read financial statements the way a pilot reads instruments. You don't need to understand every dial, but you need to know what steady looks like, so you notice when something starts drifting. For me, the drift started on a Thursday night in July. I was sitting at my kitchen table with a beer going flat next to my laptop, scrolling through the quarterly P&L that Marcus had sent over that afternoon. Payroll expenses Q2 of 2023 up 11% year-over-year. Revenue over the same period up 3%. Those two numbers should move roughly in proportion for a consulting firm. When they diverge that sharply, either you're investing ahead of growth or the money is going somewhere it shouldn't. I need to back up. My name is Robert. I'm posting this from a throwaway because both criminal and civil proceedings are still active, and my attorney has asked me to be cautious about specifics. But I've been carrying this for 8 months, and honestly, it's eating me alive. My wife has heard the whole thing probably 4 times now, and she's tired of being my therapist about it. So I'm writing it down. I'm the minority partner in a logistics consulting firm based in the Raleigh-Durham area of North Carolina. 20% equity earned through 6 years of building out the company's operational infrastructure, route optimization systems, vendor management platforms, fleet coordination protocols for our clients. Glamorous stuff. The majority partner, Marcus, owned 80%. He was the rainmaker. He brought in the contracts, handled the client dinners, wore the nice suits, the kind of guy who could walk into a room and make people want to hand over 6-figure engagements before the appetizers came out. I built the systems that actually delivered on his promises. For a long time, that division worked. I was content in the engine room. I didn't need to be on the bridge. The payroll line item was the first crack, but it wasn't the only one. Once I started looking, really looking, not just skimming the summaries Marcus put together for our quarterly partner meetings, the anomalies multiplied. Operating margins that should have been in the 18 to 22% range for a firm our size were sitting at 9. Revenue figures that didn't match the contract pipeline I had visibility into. And the headcount. When I'd first joined the company in 2014, the payroll roster showed 11 employees. The current roster showed 26. That's a 136% headcount increase. Our revenue over that same period had grown roughly 60%. In logistics consulting, those numbers don't reconcile. In any consulting business, they don't reconcile. I'm not a forensic accountant, I wasn't at the time anyway, but you don't need to be one to see that math. I brought my concerns to Marcus at our next quarterly meeting. This was August, I think, August, because we met at that barbecue place on Glenwood where we always did Q3 planning. I asked about the payroll growth. He said he'd been staffing up in anticipation of a larger contract pipeline he expected to close in Q3. I asked which clients. He named 2 prospects I'd never heard of, and I had visibility into every active proposal in our system. Every single one. I asked to see the draft proposals. He said they were still being developed and pivoted to discussing our office lease renewal. Just changed the subject mid-sentence almost. In 9 years of partnership, Marcus had never once been evasive about the sales pipeline. He was a salesman at his core. Salesmen love talking about their pipeline. It's like asking a fisherman about his best catch, you can't shut them up. When they go quiet about it, something is wrong. I spent the next 4 months documenting everything I could access as a minority partner. 5 years of payroll summaries, quarterly P&L statements, headcount reports pulled directly from the system. I'd stay up past midnight, my wife asleep upstairs, exporting CSVs and cross-referencing numbers on a spreadsheet that eventually ran to 47 rows. Each row told the same story. Money was leaving the company through payroll at a rate that the actual business activity could not explain. By the time I'd finished, I wasn't guessing anymore. I knew something was structurally wrong. I just didn't know what exactly. I retained a forensic accounting firm called Whitfield and Associates in Durham. My attorney had specifically recommended them because they'd handled partnership dispute cases in the logistics sector before, which, in the research triangle, actually narrows the field more than you'd think. I wanted people who already understood what a healthy logistics consultancy's books should look like. Not generalists who would need 3 weeks of industry onboarding before they could spot an anomaly. That sector expertise is a detail that matters later. The engagement was opened in September of last year. And that brings us to the moment I told you about at the start. Within 24 hours, Elena, one of Whitfield's accountants, walked into her supervisor's office, closed the door, and disclosed that Marcus was her ex-husband. She had personally managed his company's bookkeeping during its first 4 years of operation, built the payroll system, set up the chart of accounts, structured the vendor naming conventions, and processed every paycheck for the original 11 employees. She could not participate in this engagement in any capacity. She was formally recused that afternoon. Her name appears nowhere in the engagement letter, the audit trail, the working papers, or the final report. 2 senior associates with no connection to her or Marcus handled everything from intake to delivery. But before Elena left that office, she made one observation that would shape the entire investigation. When she had processed payroll for that company, the roster had 11 employees. The intake documents showed 26. If the audit team was looking for where the money was going, start with the names on that payroll roster. They started there. Let me explain how a ghost employee scheme actually works, because most people hear the term and picture somebody scribbling a fake name on a paper check. It's way more systematic than that, and the sophistication is exactly why these schemes can bleed a company dry for years before anyone catches on. A ghost employee is a person on the payroll who either doesn't exist at all or who exists but performs no actual work for the company. The person running the scheme creates a complete employee profile, a W-4 with a name, address, and social security number, a direct deposit authorization form routing to a bank account the schemer controls, a hire date, a job title, sometimes even a benefits enrollment form. Then they generate timesheets showing hours worked. They approve those timesheets, and every pay cycle, money flows out of the company's operating account into a pocket that doesn't belong to any real worker. The key to sustaining a ghost payroll is controlling the entire chain. You need to be the person who creates the employee record, approves their hours, and has unrestricted access to the payroll system. In a small to mid-size company where the majority owner personally handles payroll, where there's no dedicated HR function, no external payroll service, and no independent audit, it is disturbingly easy to pull off. Marcus's company had exactly that structure. He'd never hired an HR person. He'd never brought on a payroll provider like ADP or Paychex. He ran everything himself through QuickBooks, a system that, ironically, Elena had originally configured for him when they were still married in their first apartment in Cary. And here's the thing that's actually kind of counterintuitive. The biggest red flag for a ghost employee isn't something missing. It's something too perfect. Ghost employees' timesheets are always submitted on time. They never call in sick on a Monday. They never dispute a pay stub or email HR about their dental coverage. Real employees are messy. Real employees forget to clock in, file their W-4s late, and argue about overtime calculations. Ghost employees are flawless. And in forensic accounting, flawless is the single biggest red flag there is. Here's what the Whitfield team found. 14 names on the active payroll roster that did not correspond to any real person performing work at the company. 14. Marcus had been adding them gradually since 2019, 2 or 3 per year, always timed to coincide with a new client contract, so the headcount increase appeared to be a natural response to business growth. That pacing was deliberate. You don't add 14 fake employees at once. That creates a spike any competent accountant would catch. But spreading them across 5 years, bundling them with legitimate hires, much harder to detect from the outside. That's exactly why my quarterly reviews never flagged it. Each individual increase looked explainable in the moment. It was only when you mapped the cumulative trend across all 5 years that the divergence became mathematically impossible to explain away. The fabricated identities fell into 2 categories, and this is where the scheme went from garden-variety payroll fraud to something far more serious. 7 of the 14 were recycled from real former employees. These were people who had legitimately worked at the company, drivers, logistics coordinators, and office manager, who had quit or been terminated over the years but were never formally removed from the payroll system. Marcus reactivated their dormant profiles and redirected their direct deposits to bank accounts held by 2 LLCs he'd registered to a P.O. box in Clayton, about 30 minutes south of Raleigh. Because these ghost employees had real names, real social security numbers, real hire dates, and real employment histories, they could survive any surface-level audit. Pull up David Renner in the system and you'd see a hire date of March 2016, a valid SSN, a plausible title, Logistics Coordinator. Everything checks out on paper. You wouldn't know that David Renner had quit in November 2018 and moved to Virginia unless you picked up the phone and called him, which the Whitfield team did. He had no idea his identity was still attached to a biweekly paycheck. The guy was working at a distribution center in Richmond. The other 7 were fabricated identities using stolen social security numbers. This is where Marcus crossed from embezzlement into federal crime. He used SSNs belonging to real people who had no connection to his company and almost certainly had no idea their numbers were being used. Creating fake employees with stolen identities isn't just fraud. It's identity theft under 18 U.S.C. Section 1028. It's wire fraud under Section 1343 because the direct deposits moved through electronic banking systems across state lines. The federal sentencing guidelines for aggravated identity theft alone carry a mandatory minimum of 2 years consecutive to any other sentence. 7 victims, 7 counts. This is not a situation that resolves with a fine and community service. Every 2 weeks without fail, Marcus logged into the payroll system and approved timesheets for all 14 ghost employees alongside the 12 real ones. The fabricated hours always looked reasonable, 40 hours per week for the salaried positions, 32 to 38 for the hourly ones. Never overtime, never short weeks, never a single sick day. Not one. That uniformity is exactly what tripped the Whitfield team's statistical analysis. Real employee hours have variance. They fluctuate week to week in patterns that reflect actual human behavior: holidays, illness, project surges, personal days. Ghost employee hours are flat. They're consistent in a way that no actual timesheet ever is. You graph real employees' hours and it looks like a heartbeat. Ghost employees look like a flat line. And here's where they followed the money. If you're enjoying this, hit subscribe. We drop new ones daily. The approved payroll processed through the company's operating account and distributed direct deposits to banks in 2 states. The shell LLCs, both registered under variants of Marcus's middle name, which, come on, received the funds and transferred them to personal accounts in smaller increments. The Whitfield team flagged that many of these transfers hovered just below $10,000, which is the reporting threshold under the Bank Secrecy Act. That pattern, called structuring, is itself a separate federal offense under 31 U.S.C. Section 5324. So add that to the pile. 6 years, 14 ghost employees. Total siphoned $2,714,388. I sat with that report in my home office for probably an hour after the briefing call ended. Maybe longer. I remember the Whitfield guy's Zoom window was still frozen on my screen because I hadn't closed the laptop. I just sat there staring at the number. Not because it was unbelievable, I'd suspected something for months. But there's a difference between suspecting something and seeing it laid out in a table with columns and rows and a total at the bottom. Marcus and I had shared office space for 9 years. We'd argued about vendor contracts over sandwiches from that Mediterranean place in the strip mall next door, Neomond, I think it was called. He'd been at my daughter's christening. And every 2 weeks for 6 consecutive years, he had logged in and stolen from our company with the same routine as checking email. That money came directly out of the company's bottom line. My 20% stake entitled me to 1/5 of all distributable profits. Every dollar Marcus diverted through ghost payroll was a dollar that should have flowed to operating income and been distributed according to our partnership agreement. Over 6 years, the estimated lost distributions to my stake alone exceeded $400,000. $400 grand. He wasn't embezzling from some abstract corporate entity. He was reaching into my pocket biweekly with a spreadsheet and a QuickBooks login. But Marcus wasn't only defrauding his business partner. The audit uncovered a second layer I hadn't even been thinking about. The ghost payroll didn't just enrich Marcus. It artificially inflated the company's operating expenses, which suppressed its reported profitability and made the company look less valuable than it actually was. This matters because Marcus had gone through a divorce in 2021 and 2022. When he submitted financial disclosures to the family court, he reported the company's value at approximately $1.9 million and his salary at $185,000 per year. Once the Whitfield team unwound the fraudulent payroll, traced the diverted funds, and recalculated the true operating margins, the company's actual value was north of $4 million. Marcus had raised his right hand, sworn his financial disclosures were complete and accurate, and lied through his teeth. I learned more about Alina's history as the legal proceedings unfolded. She had left the company's day-to-day bookkeeping when their kids were born. Marcus filed for divorce in 2021. During the proceedings, his legal team argued that Alina had no professional credentials, no recent work history, and no marketable skills. Marcus himself told the judge, his actual words, according to the filing, she had every opportunity to develop herself professionally and chose not to. The court, relying on the financial picture Marcus had presented, the fraudulent one, awarded her limited alimony. She signed the settlement because she didn't have the resources to challenge his numbers. What else was she supposed to do? What happened next is the part of this story I think about most often. Not because it's dramatic, because of what it says about how things actually work. Alina went back to school, transferred credits she'd earned over a decade earlier, completed a degree in accounting, passed the CPA exam with a concentration in forensic accounting, of all things, applied to Whitfield and Associates and was hired partly for her academic performance and partly because hands-on bookkeeping experience in logistics operations is genuinely uncommon for a newly certified accountant. That was about 14 months before my engagement came through their intake process. The chain of events is boring if you lay it out. My attorney recommended Whitfield for their logistics sector expertise. I hired them. Their accountant recognized her ex-husband's company name on the intake sheet. She disclosed immediately and stepped away. No orchestration, no master plan. The triangle has maybe a dozen forensic accounting practices. Paths cross, but I'll say this. Alina's initial observation about the headcount discrepancy, 11 to 26, is what gave the Whitfield team their starting point. She couldn't work the case, but she could see the anomaly from across a room, because she'd spent 4 years inside those books. Her supervisor told me later that in 20 years of forensic accounting, the people who catch fraud aren't usually the ones with the fanciest software. They're the ones who know what normal looks like. They've spent enough time inside a set of books that they can feel when something is 1 degree off, the way a mechanic hears an engine knock before the check engine light comes on. That kind of pattern recognition doesn't come from a textbook. It comes from years of doing the work. The professional skills Marcus told a judge she didn't have are the ones that focused the investigation that is now sending him to federal prison. I don't know what you call that. Irony doesn't feel like a big enough word, but it's real. When Marcus's legal team challenged the audit, arguing that Alina's connection to Whitfield compromised the findings, the court reviewed the recusal documentation, her immediate disclosure, her complete separation from the engagement, the independent chain of custody on every working paper, and denied the motion. Every finding was corroborated by bank records, IRS filings, and payroll data that Marcus himself had generated and signed. The evidence existed independently of anyone who touched it. Alina subsequently filed to reopen her divorce settlement based on the fraudulent financial disclosures. The court granted the motion. The revised settlement was, from what I understand, substantial, reflecting the true valuation of a company worth more than double what Marcus had sworn it was worth. I don't know all the details and they're not mine to share, but I know that the back calculation of what Marcus's actual income had been during the original proceedings resulted in some significant retroactive adjustments. She's now a senior forensic analyst at Whitfield. Make of that what you will. Marcus is facing multiple criminal charges, The perjury from the divorce proceedings is actually the least of his problems at this point. The federal wire fraud charges carry up to 20 years per count. The aggravated identity theft charges carry mandatory consecutive sentences. His attorney is reportedly trying to work out a plea, but the U.S. Attorney's office is apparently not feeling generous. 7 stolen social security numbers affecting 7 real people tends to limit prosecutorial sympathy. I filed a separate civil suit for breach of fiduciary duty and embezzlement. That case is on its own timeline. My attorneys tell me recovery won't be quick, but the forensic report is airtight and the paper trail is thorough. Marcus put his house in North Hills on the market last month. I drove past it a couple weeks ago, didn't mean to, just was in the area. The yard looked rough. I've been told his girlfriend moved out shortly after the federal charges were filed. Didn't ask for details. I want to close with something practical because the story is dramatic but the actual lesson is boring, and the boring part is what might help someone reading this. If you are a minority partner in any business, any size, any industry, and you do not have independent visibility into the payroll system, you are exposed. Full stop. The Association of Certified Fraud Examiners estimates that payroll fraud occurs in roughly 8% of all occupational fraud cases, with a median duration of 30 months and a median loss exceeding $100,000. The single greatest risk factor is a lack of segregation of duties, one person controlling employee creation, timesheet approval, and payroll disbursement, which is exactly the structure Marcus had built and I had never questioned. Not once in 9 years. I trusted my partner. Not blindly, I reviewed financials quarterly, asked questions, stayed engaged with operations. But reviewing summary financials is not the same as having structural controls in place. A third-party payroll service that independently verifies employee identities. An annual audit by an outside firm with forensic capability. Even something as basic as requiring 2 signatures on new employee additions to the payroll system. Any one of those controls would have shortened this scheme from 6 years to maybe 6 months. I didn't push for them because I trusted Marcus, and because minority partners often defer to majority owners on operational stuff. That's just the dynamic. That deference cost me over $400,000 in stolen distributions and $85,000 in forensic accounting fees. And those are just the dollars. The forensic investigation I commissioned was the single best business decision I have ever made. It was also the most uncomfortable. Nobody wants to walk into their attorney's office and say the words, "I think my partner is stealing from me." It sounds paranoid. It feels like betrayal just to voice the suspicion. But here's what I've learned. If the numbers are telling you something is wrong, the betrayal already happened. You're not the one breaking trust by hiring an auditor. You're the one who's been trusting too long. 14 ghost employees. 6 years. $2 714 388. I own 20% of a company that was systematically robbing itself, and the person doing the robbing sat 10 feet from my desk. The only reason it stopped is because I decided a quarterly P&L that didn't add up was worth more than the discomfort of confronting the person behind it. Update: criminal case is still pending as of this month. Marcus's legal team is in plea negotiations, but the federal charges carry significant mandatory minimums. My civil suit is moving on its own timeline. I'll update if anything major happens.